Hey everyone, welcome back to the Mark Loeffler Experience. Today we learned that the inflation we're experiencing is not transitory. Now, there's a lot of smart people at the Bank of Canada. I think we could have told them that months ago. So they've said a couple things in their guidance moving forward and their predictions. They've said that the global economic recovery from COVID-19 pandemic is progressing. We can see that. Thank you, Captain Obvious. Vaccines are proving highly effective against virus, blah, 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 whatever. Right? Bond yields have risen in recent weeks due to inflation, higher energy prices, yet we're still not in full recovery. And Bank of Canada projects global GDP will grow by 6.5% in 2021. That's super strong, but it's less than what they had predicted a couple months ago in July in their last report, in last quarterly, right? And 4.25% in 2022 and 3.5% in 2023. So not as robust as they thought. They go down here to say in Canada, robust economic growth has resumed. They are predicting that growth for this year will be 5%, moderating to 4.25% in 2022 and 3.75% in 2023. What does all this mean? Let's just talk a little bit about what the predictions are. Earlier in the week, we had Scotiabank, Derek Holt. He's one of the leading economists there at Scotiabank. We've talked about some of his stuff. He talked about the housing market and the supply shortage. We did a video on that. We'll link that down below. Basically, he's saying he is seeing 8 interest rate hikes over the next 2 years, starting in spring of 2022. So for someone like me, I have a variable rate mortgage and the bank prime is 2.25% and I have 1% minus, so my interest rate is 1.25%. If it goes up a full 2%, my interest rate is now 3.25%. It obviously doesn't go there overnight, yet at some point I'm going to look at it and say, if I think that's actually a possibility, maybe I'll lock in a fixed rate term for a couple years. Stick with me on that. I haven't decided that yet. I'm still on the variable train, and we'll link that one down below and just to explain why. Bank of Canada had basically said we're not going to see it until the third quarter of next year. Now they're saying it could be early second quarter, April or May. We got our good friends at RBC Economics. Their headline is Bank of Canada switching to reinvestment phase of quantitative easing. So what does that mean? Well, that means that fixed rate mortgages actually are probably going to climb because that's tied to the bond rate. If the Bank of Canada is not buying bonds, buying new bonds, basically what they're going to do is they're not going to sell what they own. They're not going to buy. They're just going to continue at the level they're at. So if something comes up, they will sell and buy, yet they're not going to add to the pile. So like basically they're pouring money into the government. They're keeping bonds rates low, which obviously benefits people like me who go out and invest in property. So I might be looking at sooner rather than later locking in some CMHC mortgages on some of my apartment buildings, because that tells me that interest rates are going to go up. All I'm doing for everyone here is, what does this mean for us investors? Money is going to cost more. That's what that means to me. I'm going to just share this with you. This is anecdotal, yet I've seen it time and time again. Banks will raise interest rates at the end of the year into the winter, and then during spring housing market, they're in competition with other banks, they lower their interest rates. So it costs less when you get a mortgage in the spring than if you get it in January or February. If you don't believe me, just watch. Happens every year. I guess a couple of things to note in this Bank of Canada is inflation is not transitory. It is here to stay. They're going to start fighting inflation. My prediction is that they're going to start a lot stronger language in that in 2022. They have said they're going to wait for full employment again. This tells me they're not going to wait for that. They're going to put the brakes on. So unless the government puts in more stimulus, which they've also stopped, there's going to be a lot less money floating out there because they're actually worried about this inflation, which I don't know, in my opinion, again, that what they're going to do is going to have any. Well, I mean, it's going to stop some inflation, but there's still container ships backed up everywhere. Microchip shortages are still going on. So I don't know how much they're going to do. I know inflation is here to stay for a bit, which is good and bad for us because, again, they're going to start raising interest rates. The Bank of Canada is saying that they're going to do maybe 5 times over the next 2 years, starting beginning at the end of second quarter next year. Scotiabank is saying 8 times. Where do you think? Is it going to be 6? I mean, that's 1.5 points. That means my 1.25 is going to go to 2.75, which, let's be honest, is still free. You're still doing really well at a 2.75% mortgage. Obviously, it's not 1%. We all knew that wasn't going to last forever. Well, some of us did. But that's going to have an effect on asset values. You can't buy a 3% cap when you're getting a 3% or 6% mortgage, right? It just doesn't work unless there's a heck of a lot of upside on that. So they're saying 2 things. They're talking out of both sides of their mouth, which I guess we could come to expect from a government agency, is that inflation is going to be higher, which we knew, yet economic growth is going to be slower. Demand is still going to be there. I think Scotia has this right. I don't think we're going to see 8, but I think the Bank of Canada is going to get way more dovish in January, February 2022. They're going to start hacking away at inflation. I don't know that the government wants them to do that because they're enjoying this more than anyone. They're more indebted than most people. If we have 4% inflation, then their debt goes down by 4%. And then, obviously we have some growth, so their debt goes down by 4%, and we have some growth, so therefore they can just go ahead and borrow some more money and get us more in debt, which is what they're going to do. So what is the one thing that could stop them from raising rates that 8 times? In my opinion, I think if the US doesn't recover as quick and they're not raising interest rates, it will cause the Bank of Canada to pause. Why would it do that? Because the more we raise our interest rates, the higher our dollar goes. The higher our dollar goes, it means our exports become more expensive. We need to export to the US for our economy to work. That's why they always try to keep the loonie right around that $1.20 mark for a US dollar. Because at that point, we can sell into the US, we get a bit of a bonus, and we're pretty much laughing. Yet what they're talking about, if they raise them that 8 times, especially with Scotiabank, I think that will put us far ahead of the US, and the Canadian dollar will go up in value based on the US dollar. I just wanted to do a quick video today on this. Yeah, it came out Wednesday. This is going to come out Thursday. Everyone enjoy. I'm down in Las Vegas right now checking out some properties. So if you got any ideas for properties down there, let me know. Comment down below. Like and subscribe. We'll catch you next time.